Okay? All right. Ladies and gentlemen, welcome to an all-new edition of What Are Your Thoughts here on the Compound YouTube channel, which has just surpassed 150,000 subscribers today for the first time ever. We clapping? Do a little clap?
Absolutely.
All right. Michael, do you have anything you want to say to the Michael Batnick is here with me as always, by the way. Do you have anything you want to say to the folks about 150,000 subs? What's up?
It's a lot of people. I want to say thank you to everyone. As somebody who consumes a shitload of content, I know there's only so many hours in the day. So
True.
The fact that you all choose to allocate some of those hours to us means a hell of a lot. So thank you.
Yeah, that's a really good point. And as the world's oldest YouTube influencer, I'm 47 years old. If you had told me 10 years ago, like I was going to be a channel on YouTube with 150,000 subs, I'd be like, no, I'm not. Who would want to watch that? And yet, here we are. I think that's a really good point. Like, there's only so many hours in the day. So one of the things we try to do with the show is make it and all the shows we put up, make it as nutritious as possible. So if you spend time with us, whether it's 10 minutes or an hour, like we're filling that time with stuff that you really need to know or might be interested to learn or whatever. Like that's the guiding principle behind everything we do. And apparently you guys are picking that up, and we really we appreciate you rocking with us. So thank you. All right, we have a sponsor tonight, Michael. Why don't you tell us who the sponsor for the show is?
We have a great sponsor. It's WAYT Charts. We're going to be leaning on them heavily for a lot of the charts. This is a chart-heavy show. I think this might be a what are your thoughts world record. Josh, I noticed, like, if the audience noticed, hey, what the hell is Michael doing on his keyboard while Josh is talking? It's like a 98% chance I'm on WAYT Charts. I'm fact-checking.
Don't mad at you, but you're right.
I'm seeing what's going on. I use it for, what don't I use it for? I get nutrition tips on WAYT Charts. That's how good it is. Everything.
Do you know when we do halftime report, I often have 5 or 6 different WAYT Charts tabs open. And I'm not using them for streaming quotes, but just like to get an instant snapshot of whatever company just reported news or we happen to be talking about. Literally, WAYT Charts is the best tool on earth for that. So we love it for so many reasons. And thank you, WAYT Charts, for sponsoring the show. We have an offer. What are we telling people to do?
If you want to check out WAYT Charts as a first-time user, tell them we sent you. Get 20% off. Can't go wrong. Okay.
Go to go.whitecharts.com/compound. Big breakout for beta. And this is weird. So I kind of intuited this on my own, just looking at the stocks that I look at. But then 2 of my favorite technicians, arguably everyone's favorite technicians, both published on the same topic. This high beta versus low beta breakout that we're seeing, which effectively is now leading the S&P 500. So Ari wrote about it and JC wrote about it like within hours of each other, I think. So I don't think they got the idea from each other. And when you have 2 of the most well-known, most talented technicians on the street focusing on the same thing that's happening, I think it demands your attention. So we're going to open up the show with a couple of charts from those 2 gentlemen, and I want you guys to see what the technicians are seeing as I think we just closed in a new closing all-time high. Do I have that right? Okay.
The S&P,
all right.
Yes.
Ari Wald is the chief technician at Oppenheimer, and I think he just won some big award or got some sort of promotion there. I forget. I congratulated him on LinkedIn because I spent like 10% of my day these days congratulating people, but I forgot what it was. Anyway, shout out to Ari. Ari says there is a structural shift in capital markets, and that's actually his favorite sector in the stock market, which we can talk about later. But this is Ari right now, and we're going to put up chart 1 while I narrate. We utilize the high beta versus low volatility ratio as a signal for offensive versus defensive leadership. Bears may point to the failure for this ratio to confirm the S&P's latest price high as a market top warning. We see a ratio testing multi-year resistance and upholding its 200-day moving average. This leads us to favor a beta breakout, a potential catalyst for the next leg of the advance in our view. Conversely, a break below the ratio's 200-day average would pressure our outlook. So basically, the idea here, what you can see in the chart, the top pane is the S&P 500, which you can see breaking out to a new leg of the bull market. And then below, Ari is showing us high beta stocks versus low volatility stocks. So basically the inverse of each other. And as you can see, high beta is starting to run away with the leadership here. And of course, if you're a technician, that's kind of what you want to see leading at new highs. You definitely don't want to see low vol like consumer staples as your leadership group if you have a choice. So I thought this was an interesting way to think about the current new high and the confirmation that the technicians are getting here.
You know what's interesting about these ETFs? So SPHB, I think that's the high beta one that they're looking at. These are both Invesco products. Yeah. Do you remember SPLV, the low vol one? Mm-hmm. So SPLV, for whatever reason, and I think I suspect I know why, but it's got 10 times the amount of assets as the high beta one, despite being a serial
financial advisors.
Right, despite being a serial underperformer. There's $6.9 billion in SPLV and just $608 million in the high beta ETF.
I never would have guessed that. Is that right?
10 for 1.
And how much has high beta outperformed low vol by? I know recently it has, but just in general.
Let's see.
We don't have to do this now, but that's really interesting.
Guess what? Y charts. Just give me 2 seconds. I got it right here. All right, so over the last, let's go 3 years. You know, the returns aren't, the gap's not even that wide. All right, 5 years, it starts to get crazy. For 5 years, it's 115% for the high beta and 28% for low vol.
So for people who are somewhat newer to the investment markets, when we say high beta, we're talking about a quantitative metric that basically can be calculated. These are the stocks that have the biggest moves on a daily basis. They end up in that bucket, the stocks that move. So you could picture there are certain industry groups that are going to lend themselves more to that sector. And again, it's not people's judgment. It's just quantitative.
No, so like semiconductors might have a beta of 1.2 to the market, and the beta is just the market's beta. So it's just the index. And utilities and consumer staples might have a beta of 0.7. So lower, things that move less than the market. So if the S&P is up 1% in a given day, you would expect consumer staples and defensive names and utilities to be up, I don't know, 80 basis points or whatever. So that's the low vol versus the high beta.
Yeah. So beta, basically the way it's expressed, the way it's expressed is if 1 is the S&P's beta, meaning the S&P went up 2% today. If a stock went up 3% today, it's 50% more beta than the overall market. So it would be a 1.5 beta. Am I explaining that right? That's how that would be expressed. So when you're looking at a stock and you just want to get a sense of how volatile or non-volatile it is compared to the overall market, that's what that's measuring. Let me put this next chart up from Ari. So this is Ari Wald. Whether selectively or broadly bullish, we're most bullish toward our advocacy for the momentum factor, meaning stocks that are already going up. While the bull case is for low momentum to reverse its year-to-date divergence and keep pace with high momentum's steadily paced uptrend, we believe high momentum still offers the most attractive risk-reward balance based on the current stage of the equity cycle. We remind clients that the stocks you don't own often support a portfolio as much as the ones that you do. So he's saying, yeah, it's a new high, but I think you want to stick with the high momentum names. And you can see in red the low momentum names really not doing much of anything at all. And again, in the second pane below, that's a ratio chart. That's high momentum stocks versus low, and you can see the clear breakout in investor preference for high momentum names. So right now, and you could say you don't like this, or you could say it's not going to last, or whatever you want to say, but the reality, this market is being led by high beta, high momentum stocks. I suppose that's what you should expect to find at all-time record highs. I don't think it's terribly surprising that that's the makeup of the current rally. What do you think?
Yeah, it's what you want to see. You want to see leaders leading. That's exactly what's happening.
All right, let's do this one from JC. JC Peretz, allstarcharts.com. Here is one of my favorite risk-on, risk-off indicators, looking to complete a multi-year base and break out to new all-time highs. So he's putting this out at the same time Ari is. This is the S&P high beta versus S&P low volatility, also another ratio chart. And JC is clearly showing consolidation above prior support above prior resistance, which is now arguably should be looked at as support. And here's his explanation. This chart of high beta versus low volatility looks a lot like the equally weighted S&P 500 and NASDAQ 100, which has served as a better representation of the typical stock than some of the popular tech-heavy market cap-weighted indices. An upside resolution here would be the most bullish thing for this market that I can think of. And I believe the higher probability outcome is, in fact, an upside resolution. Chart off. This is a bull market. Good things happen to shareholders during bull markets. A breakout here would be very rewarding for people who own stocks. It would be detrimental to those who do not. If you do not own stocks in a bull market, then what are you even doing as an investor? To JC's point, we made this one. Here's NASDAQ 100 versus equal weighted S&P 500. Thanks to Sean and John for getting this up. So, I mean, this is as clear as a bell. This is NASDAQ versus equal weight. Another obvious, risk-on indicator. But again, this is what bull markets look like. And this is exactly what should be expected.
All right, sticking with this theme, but moving on to my topic. It is a stock picker's nightmare. This is from Sentiment Trader on Friday. The percentage of S&P 500 stocks outperforming the index over a 21-day period dropped to the lowest level in history. Just, what was that, 15%? I mean, unbelievable.
Well, the good news is those are the low volatility stocks.
Right. Right. The run is bordering on historic. Chart Kid made a chart of the 50 largest stocks over the last 6 months. And it's not quite at historic highs, but the 50 biggest stocks, they're winning big time.
Hold on. Explain this. The top one is the S&P 50. Okay, I got that.
And the bottom one is a 6-month rate of change.
Okay. So, yeah, I mean, like if you were to stop the market right now and say, like, what was the dominant theme of this year, it's everyone crowding into the highest quality stocks. Now, once again, that sounds really bad from like a market prognostication perspective. It's like, how did the bull market end? Oh, only the S&P 50 were rising.
Right.
But as we talked about last week, we've been through these episodes before, and they frequently end with an upside resolution where the rest of the market catches up.
I'm so glad you mentioned that. Chart from Savita Supermania Entertainment Bank of America. Bad breath usually mean reverts to the upside.
Yeah.
There we go. So
that's right.
So exhibit.
Tell him, Savita.
16 on the bottom. She says, in years of mega cap leadership since 1986, the market was up the subsequent year 75% of the time. So you've got, I don't know, pick a year. So 95, for example, the top 50 were up 38%. They beat the S&P by 3.7%, and the next year the market was up 20%. So it's not always, but the average is 12%, positive 75% of the time. The median is 16%. The rest of the market usually catches up with the rest of the winners.
So you call this a stock picker's nightmare. So I want to agree with that, except like a lot of stock pickers stock picked NVIDIA and Apple, and they're doing just fine. Like I feel like this is more a nightmare for an investor, professional investor, who has a mandate that forces them to, let's say, I'm making this up, only own every sector equal weight. So like they have to find stocks in every sector, or they can only own up to 2% in an individual position. Like for people that are operating under that mandate, it's horrible. But if you don't have those sort of mandates, you don't have an investment policy statement, and you're just running your own portfolio, you're probably picking a lot of the stocks that look unbelievable right now. And why? Because they've looked unbelievable.
Yeah, as long as you own NVIDIA, you're doing fine. Apple,
Microsoft, Meta, Alphabet, Amazon. It's not that hard. Like, is it that hard? I'm being serious. Oracle.
Listen, I mean, put the previous chart, put the Sentiment Trader chart back on. Yeah, it's hard. This is historic. If you are not in the Sentiment Trader chart, if you are not, thank you. If you are not in those 5 names, not even not in them, if you don't have an equal weight to them, you know what I mean?
Yeah.
Like,
no, I know it's really hard if you're
you're-
underweight relative to the index. But
it's brutal.
But again, I want to come back to what I just said. That's true, except the best performing stocks are also the most popular, most widely held stocks in the market. It's not some obscure, weird shit. By the way, so I'm recording the audio chapters for my book that comes out in September. And today I recorded a chapter that looks back at 2013, which was the first time the S&P made a new all-time high since the top in 2007. And I'm describing what was going on in the market in 2013 because a lot of people had trouble with this. They thought it was a double top. They're like, uh-oh, the last time we got to these levels, it was 2007. You know what happens next. One of the interesting features of that 2013 market was that a lot of the biggest winners were biotech and solar stocks. You remember Celgene, and people didn't know these stocks. Today is different. Everyone fucking knows Alphabet and Amazon. What's the problem? Just buy them both and shut up. So
I mean, come on, that's ridiculous.
I'm being honest with you, though.
Just buy them both and shut up?
I don't know. I'm kidding. But it's not like people have to go hunting for some obscure shit to stay with the indices this year.
Listen, I think you would forgive active managers for not the ones that didn't pile into NVIDIA. They're not idiots.
I agree, but it's not NVIDIA. Just show me a chart of the S&P 50. If you tell me it's one stock doubled this year and everything else is down, it's a different conversation. That's just not the case. So my point is, I think 2013 was probably harder than 2024 because the nature of the leadership of this market are the most well-known stocks.
If I remember correctly,
and by the way, everybody owns them. 2013,
I remember the naysayers in 2013 were saying, well, this is it's consumer staples and it's utilities and it's defensive names, it's healthcare. Like those were the bearish talking points in 2013, that it wasn't the high beta names.
Yeah.
Remember that?
Oh, that's 100% the case. I think that's absolutely right.
Yeah.
People said, oh, you don't want to be in a market that's being led by healthcare because it's defense. Listen, it's never, all right, let me explain this way. It's never easy. It's never easy. But I think it's got to be easier if I tell you the best performing stocks include Apple and Microsoft versus 2013 when it's First Solar and Best Buy. I mean, it's just, you can't say this is harder than that. That's all I would conclude. Is that such an outrageous, actually, you know what?
It's not outrageous, but it's very hindsighty. It's like, well, why didn't you just own the biggest winners?
But the biggest winners are the most well-known stocks, and everyone owns them, and everyone does own them. So that's my point. It's not hindsighty. These were the biggest stocks last year, too. They've been the biggest stocks for 5 years. So it's not that hindsighty.
But if you look at the percentage of mutual funds that are outperforming the S&P, it's not a lot.
Dog, you know what was hindsighty? If I came out in December of 2022 and I was like, oh, why didn't you just own oil stocks? Like overweight oil. That's hindsighty. These, again, you just showed me the chart. The S&P 50 is leading the S&P 500. And by the way, everybody knows not only the stocks, but they know the companies, they know the products. Come on, it's not.
All right,
it's
another
not that
thing,
difficult.
another thing for active managers to defend them a little bit is like they're supposed to be differentiated. If you want to just own those stocks, just fucking own the S&P. You don't pay me to have an equal weight to Apple, and that's the talking point.
We 100% agree on that. They should, no active manager should strive to look exactly like the S&P.
Right, and looking different than the S&P has killed you.
Unfortunately, that's how you get fired. All right, I want to go through the best and worst of the first half. I think this exercise is helpful. If you're somebody who professionally is involved in markets, you should have some idea of what's happening. And I know a half a year is arbitrary. Like, what does 6 months mean? Nothing. But what does 1 month mean? What does 10 months mean? Like, you have to just decide, hey, every quarter, every half a year, I just want to go back and review what's happening so I don't talk out of my ass and I don't miss the opportunities that might be created. So we're going to do the top 5 and bottom 5 performers in the S&P 100. So this is where, everyone knows these companies. The question is, do you know how they're doing so far this year? So here are the technical charts. So here's the list. Top 5, NVIDIA, GE Aerospace. That was a surprise to me. Lilly, not a surprise. Arista Networks, Broadcom. And then bottom 5, Accenture, McDonald's, Boeing, Intel, Nike. Keeping this table up, before we go to the charts, what's the first thing that jumps out at you, Mike?
The market cap of NVIDIA.
Okay.
Was that the wrong answer? What
3.2 billion?
Trillion.
Okay, here's what jumps out at me. This is the S&P 100, and the worst name in the index is only down, I say only down, 30%. That's Nike. Do you notice that one of the worst performers, over the last year is actually still up 8%? Like another, I'm telling you, these are the 5 worst stocks in the S&P, and one of them over the last 12 months is green.
It's a bull market.
Intel. Now it's down 31% year to date. But I would expect if you said to me, I'm going to show you the 5 worst performing stocks in the S&P 100 over pretty much any period of time, I would guess that they're probably worse than these. Mm-hmm. So Accenture's down 15% year to date. McDonald's is down 17. Boeing down 29. Intel down 31. Nike down 33. Not great, but hey, this is, to your point, this is what a real bull market looks like. Let's go through some of these charts. Here's NVIDIA. The stock is only up 165% year to date. Performance over the last year, 209%. And this is the best stock in the S&P 500. Next. This is GE Aerospace. So I guess they kept the ticker GE, and all the spinoffs got something else. Would you buy this chart here? I don't love it.
No.
You don't like these gaps, but that one looks like a. Which gap do you think gets filled? The one above or the one below?
I don't think this chart is actually right, but keep going.
I think it's because of the spinoff that it looks like that.
Yeah.
All right. Let's look at the next one. Here's Lilly. So, hey, man, this thing does what the FANG stocks do. I think it's an $800 billion, $886 billion market cap. It looks like it's involved in AI, but it's not. It's involved in GLP-1.
So about 5 quarters ago, this thing gapped from 450 up to 500, and now it's at 930. So not all gaps get filled, just most of them.
What a monster. This thing is incredible, right?
Yeah.
All right. This is Arista Networks. Just got added to the S&P. I can't believe, how is this an S&P 100 stock? What's the market cap on this thing? 114 billion. Must have just made the cut, because that's not that big of a company, but I guess it's big enough. We talked about this on the show. I don't even want to remind you. I think it was maybe $70 or $90.
Really?
Yeah, I didn't buy it. You didn't buy it.
I didn't buy it.
Nope. Oh, I know. All right. Broadcom, AVGO. People ask why they have that ticker symbol. It's involved in like a merger, Avago or something, but then they ended up changing the name to the thing that got bought, Broadcom. I think that's how it happened. Anyway, this thing has rivaled NVIDIA at least this year. This stock has just been an absolute gangster. Let's see, up 104%, 12 months, 55% year to date. Market cap is almost $1 trillion, $800 billion. Absolute monster. Is anything surprising about the names that happen to have made the list?
I don't know about the names, but the ascent of some of these names. What was before AVGO? Oh, ANET. Yeah. It's fast. Like these stocks are going vertical. It's too much.
It's happening really quick. All right, let's very quickly. We'll go through the losers. I want to see if you would buy any of these charts. Here's Accenture. This is consulting company basically.
We spoke about. Yeah, I don't like this.
Yeah, it looks like shit.
I'm just talking about the chart. Just talking about the chart.
Yeah, no, greatest company in the world. All right, here's McDonald's. This is about to make I think, a new 52-week low, like any second. Trading 245, challenging those lows from last October. You think this one breaks the downside? I do.
Yeah, I do. I own it. I think it's my smallest or second smallest position, but I will be adding. I hope it goes a lot lower.
You're going to add once it breaks below the low?
I want it to go a lot lower because I feel comfortable owning this name for years.
Okay. Boeing. You couldn't pay me.
No, I just see no reason to be involved in this.
I know that's a buy signal when I start saying shit like you couldn't pay. Like if you bought the stock, I wouldn't accept it into my account.
Okay.
That's what I'm. That's where I'm at with Boeing. I've watched people fight this stock from being long this thing for the last 10 years, and you talk to them like, are you like, what's your outlook? And they're bullish because the company might win a lawsuit.
Yeah, no, I don't like it.
It's horrible.
What
All right,
else?
Intel
No.
stock sucks.
No.
Put
Chart
this
on?
up. You know what happens though?
Oh, we don't have it. It's just a garbage chart. No thanks.
We do have Intel. All right, maybe we don't have it right now. Do we have
But
Nike?
look at the Intel filled the shit out of that gap. So
Okay, great.
Nike, no. I told you I sold it last week.
This is the worst stock. This is the worst stock in the entire market right now, in my opinion, and maybe the one that most demands that you keep it on your screen, because one day this one's going to set up.
Totally.
Like I think it's going to have a short-term bounce because of how much it's down, but then that bounce will fail and it'll roll back down. You have to buy this like when no one's talking about it anymore. I think you need like 3 quarters for the sentiment to just completely wash.
I agree. Well, guess what? The fact that it had its worst day, I think, ever, and it's still relentlessly lower. There's not even a sniff of a bounce. It's pretty bad. It's pretty gnarly. Yeah. So at some point, this will be a nice setup. It'll be buyable. It's just there's no rush here.
Too soon. And I feel the same way about Starbucks. Got very tempted. I got very tempted at 72, but then I've said, you know what? I don't do this shit. I don't buy stocks at all-time at multi-year lows. I gotta get away from doing that.
Smart.
I do it rarely, and it's just not my style.
Yeah.
So I'm gonna let
I do
that
it too
one
often,
go.
but I am a Starbuckser.
Okay. You're up.
Okay, where are we going next? Okay. The second to last bear was Mike Wilson, who is courageously calling for a 10% correction. Wow.
Again, he's still doing this shit?
He's doing it again. So he was the last bear standing, and now the last one really got taken out. So Marko Kolanovic to exit. There's a Bloomberg headline to exit amid string of poor stock calls. He was bullish in 2022, and then he turned bearish at the bottom. I'm sorry. He was bullish in 2022, turned bearish at the bottom. Not great. Just a couple of weeks ago, they were calling for a 25% drop. John, throw this chart on. This was from May 20th. So not great. All right. A JP Morgan biography shared with the Financial Times praised Kolanovic for his timely and accurate short-term forecast for the stock market, noted that he was inducted into the Institutional Investor Hall of Fame in 2020 following 10 consecutive years of #1 rankings. This shit is really, 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 really hard. Really hard, obviously. But, the last bear got taken out to the woodshed. Probably like not exactly what you want to see. That you can't really find a bear. The last bear just got fired. Not great.
Yeah, Marko Kolanovic, super smart guy, respected everywhere, just completely wrong for 3 years straight. And you can't do that, because people are actually listening to him. And I don't think they're buying and selling every time he talks, but I think it colors the customers of the bank. It colors their thinking and their feeling. Now, one thing it's worth saying is that nobody can actually do this.
Right.
So if you think there's somebody that literally could do this, you believe in fairy tales and magic, and it's really stupid. The purpose of the commentary that these guys put out is just to color your expectations and help you fill in some blanks and get a better understanding of what's happening. If literally you're betting on price targets hitting, come on.
Well, guess what? You could be wrong in a bear market. If you're bullish in a bear market, you might have a chance. In a bull market, if you're bearish for too long, you're fired.
100%, because in the end, people are trying to make money from the long side. You got some hedge funds that are trading both sides. You got some strategies that are trying to capitalize on volatility. But outside of that, what people really need to be told is that a bear market is an opportunity, and not, hey, you should sit in cash and wait for the bear market to be that opportunity. So, I don't think there's anything wrong with forecasting bear markets, and someday we'll have a new crop of people that come along and get it right. The problem is they can't tell you when it's over, and at the lows, they always think it's about to get worse. And then after it recovers, the next thing you hear out of their mouths is, for my next bear market call, because once they've captured that lightning in the bottle, that feeling of being right when everyone else lost money, they're drunk on it. And that's not the case with Kalanovic, but I'm just saying that's why even if somebody nails this bear market call, like for the rest of their career, you can't listen to them.
It's similar to active managers. They don't pay you to look like the index. Like do you pay a strategist to tell you, don't worry, everything's going to be fine?
No.
No.
Like,
okay, cool. I don't need you to tell me that. Like, warn me.
Yeah, no, I agree. But the problem is these are very highly paid people. They're very visible. And if you're wrong for too long, you kind of are not satisfying you're not satisfying the office that they've put you in, because people tune you out. And so, of course, like if the job is communication, which is what the job is, if people don't want to hear from you anymore, you fundamentally can't be in that role. You can't do the job.
Okay. So you've got the VIX at very low levels. You've got the last bear taken out. It's not super clever to say we're probably a correction is coming. Okay, big deal. Fine.
Thank God.
Yeah.
I need a correction.
Yeah.
I want to buy all-time highs every month. Like it's okay. It's not the end of the world. No one's getting credit for it. If you've been saying there's a correction coming for 30% now, like I'm not gonna high five you when it happens. I don't want to be high fived. If I come out tonight and say I predict the next correction happens starting tomorrow, and it does, I got lucky. 1,000 other people could have picked 1,000 other days.
Hey, dude, guess
to make
what?
That same call.
A 10% correction takes us all the way back to where we were at the end of April.
Right. Listen, shout to Marko Kalanovic. You know who his replacement is? They just upped Dubravko Lakos, who I really like. I like him personally, and I like his research. Dubravko's been on CNBC with us a million times. Very thoughtful, really great at intermarket analysis, understands international, understands everything.
It is an impossible job. The clock is always ticking on these people.
I was gonna say, like, all right, Dubravko got the job, turn the hourglass over.
Right.
Now,
it's an
now we'll see how long he'll see how long he can stay in that role. Okay. But I do like him. I think that's a great choice. I think this is you.
Nope.
Oh, this is me. So I posted this on LinkedIn, and people like got really upset about it. Not that I posted it, but just about like what is the data really saying. So let me walk you through. It's not a controversy, but let me walk you through what's going on here. Put this chart up. Basically, this is the cumulative gain or loss in adjusted gross income. So in other words, the tax revenue that came from people's salaries who left the state or went to a different state. So as you could see, California, New York, Illinois, New Jersey have been bleeding gross income cumulatively between the years 2019 and 2022. And Florida, Texas, South Carolina, and Tennessee have been the beneficiaries. I'm going to read some of these numbers just for the people who are listening. The IRS last week, this is Wall Street Journal, published its annual data on the migration of taxpayers and adjusted gross income between states. California ranked again as the biggest income loser, minus $23.8 billion in 2022, followed by New York, minus $14.2 billion, Illinois, which is Chicago, minus $10 billion, New Jersey, minus $5 billion, Massachusetts, minus $4 billion. The top gainers, Florida took in $36 billion worth of adjusted gross income, Texas 10, South Carolina 4.8, Tennessee 4.7, North Carolina 4.6. Florida gained twice as much income in 2022 from other states as it did in 2019. Texas pulled in 150% more adjusted gross income. So this is something that predated the pandemic to some extent, accelerated at the peak of the pandemic, but now is not stopping. And people got really mad for me pointing out that it hasn't stopped yet.
What were they saying?
They're saying, why does your data only go back to 2022 and not 2023? Because it's from the IRS, dickhead. What do you want from me?
Was there anything intelligent that was said or anything interesting?
Well, so that was the big one. Like, oh, why don't you use more recent sources? Okay, I have more recent sources. Literally everyone I talk to has a friend or a neighbor still moving to Florida. That's my source. The other thing I heard was that, oh, that's because there were still lockdowns in 2022. As if that trend is going to reverse in 2023.
Wait,
When was the
lockdowns? Hold on, lockdowns?
Yeah, there were none. Believe me, I lived here. I could tell you New York was not locked down in 2022. I went to like 18 concerts that year. Okay, I was at Madison Square Garden for Knicks games. So forget that. But then the other thing I was thinking is like, all right, maybe the data is overstating, but directionally, are you telling me it's wrong or it's going to reverse? Are you telling me people from Dallas are moving to Los Angeles? What the fuck are you talking about?
Oh, relax. I actually do think it's going to reverse. I think I would fade Florida.
You think people from Florida are going to move to New York State?
I think that it's going to slow down.
Okay, two
Yeah,
different things.
yeah.
I agree with you. It's going to slow down.
Potentially reverse.
Okay,
I think after a couple of years, people will be like, "It's too fucking hot down here. It's too much."
that's very possible. And the other thing is, there's very little cost differential between the areas of Florida that you want to live and the areas people are leaving in New England and New York.
Yeah, so I do think I think there's be a certain amount of people in the next 3 to 5 years that are like, "That was fun. I'm glad I did it. I just want to be back in New York."
Yeah. So I would take the other side that there's going to be any kind of reversal, and I'm looking at the real estate leases being signed, not just for apartment buildings, but commercial activity, offices. Last week there was $1 billion worth of development loans for 2 apartment complexes on Brickell in Miami. I do not think these people are doing something dumb. I think they are understanding the demand coming in, and they are mobilizing accordingly. And the amount of building and business migration happening probably means that by the time we get IRS data for 2023 and 2024 someday, we'll realize that the end of the pandemic did not mean the end of the migration. So maybe it's slow. It should slow down versus 2020.
Yeah.
But I don't know if it slows down versus 2022. I mean, we're gonna find out. We're gonna find out. I also think you'll see some other states on that list. I think you'll see Colorado popping up as a net migration winner. I think you'll see more people into North Carolina, South Carolina, bigger. So maybe it doesn't all go to Florida and Texas. But I don't see it reversing. All right, you're up.
Okay. Warren Pies showed that analysts are expecting imminent EPS growth for the S&P 500. It's been 2 years of flat earnings growth. And then he has another chart saying, there's Warren, it's easy to doubt this inflection, but it does track with the historic path of earnings through bull markets. In other words, it is normal for the market to bottom and then have earnings flatline for about 1.5 years before moving higher. Next chart, please, John. And we better get it, because if we don't, the market is going to be expensive and investors are going to be disappointed.
Okay. So they think that, so show me again what the projections are for earnings. That dotted line on the first chart?
Go back. Oh, here it is. Yep.
Okay. So the dotted line is the trajectory of analyst expectations.
Well, there's two dotted lines. The dark one, the thicker one, was a year ago. And the thinner one, which is really going vertical.
They're getting more aggressive. They're getting more aggressive.
They're raising their estimates.
Okay. Show me the next chart. So what's your takeaway from this?
Well, as Warren says, it sounds like crazy that all of a sudden earnings are going to hockey stick higher, but it's actually been pretty much in line with previous bull markets.
Why do you think that happens? Like there's this pause during a bull market where stocks catch up to the earnings growth, and then and then earnings growth consolidates for a little while, and then it reaccelerates.
I couldn't tell you. I don't know.
But that's what we're saying is.
That's what he's saying. So if you look at, I had WAYT charts create a chart. Thank you, Rushi. Looking at sector breakdowns of earnings per share estimates for the next 12 months, and not surprisingly, information technology is pretty damn high, 39% growth estimated. But look at healthcare, and I'm guessing that this is all the GLP stuff.
Wow. So this is not a sector level, and you have some companies that are so dominant within the sector. So that's how like AI and GLP-1 might account for like half the expected earnings growth of the S&P this coming year.
But the point is, all this shit, it's baked into the pie. And so if earnings materially disappoint, like that's how you get a pullback, and maybe worse.
Or, and hear me out, it's possible. Let's take energy. We expect these companies, Wall Street expects these companies to show 22% earnings growth over the next 12 months. These stocks are selling like 10 times earnings net of cash on the balance sheet. Like some of the, like
What stocks?
the stocks that dominate the oil indices, these gigantic integrated natural gas companies. This is one of the cheapest multiples you've ever been able to pay on a forward earnings basis in that one sector. And I haven't gone through all of these sectors, but you could have another year where the expectations are too high in some sectors and the other sectors take the leadership. So I just showed you the top 5 S&P 100 companies. Yeah, 3 are tech, but 2 aren't. You know what I mean? Like it's a conceivable story. I don't know that we really have companies in these other sectors that could replace like the biggest technology companies if earnings growth for tech goes bad. But you could have a scenario where these other areas outperform just because the expectations are not that high and the stocks aren't that expensive.
Put a pin in that. We'll get there in a second. I didn't even know that this was a survey that the New York Fed did. They have earnings growth expectations, and the median 1 year ahead expected earnings growth from, again, a survey of consumer expectations. Looks like it's breaking out to an all-time high. So I don't know.
Wait,
I thought that was
this is consumers talking about what earnings growth?
I don't know. I guess the market.
Okay. All right. So everyone's in the bull camp, I suppose.
Yeah. All right. So I'm going to make the case for financials. I was going to do something different. There's actually, despite the fact, and this is well-trodden material, that the market is at an all-time high, there's a lot of stocks that have pulled back that have pretty attractive entry points. So I could have chosen, I had a hard time narrowing it down by make the case, but you made such a compelling case on TV today that I stole what you were talking about. We're going to talk about financials. All right. Chart on. So Chart Kid made a chart looking at the percentage of XLF components that are above their 200-day moving average. And this is a good thing. 83% of financial stocks are above their 200-day moving average.
Wow, I wouldn't have guessed that.
When you look out over the next 6 and 12 months, this is not bearish. Now you have to remove the GFC because that obviously distorts all the data. Because financials did actually quite bad during the Great Financial Crisis, it turns out. But 12 months after they return, they meaning financial stocks, 6.1% compared to 4.5% of all periods, and it's similarly a little bit higher 6 months out. So just the fact that they're like either overbought or that a lot of them perform well, that's not bearish. It's the opposite. It's bullish.
How many? Do we know how many instances there were where the XLF components, where 80% of the XLF components were above the 200
Many.
day?
Rewind, John. Rewind 2 charts, please.
So this is showing you all those instances.
Yeah, a lot of them.
Okay. Oh, yeah. So all right. So this happens often.
Yeah.
And the 12-month forward return is pretty damn good when we get a flash like that on average.
Yeah, it's not bad. All right. I own two financials. I own MasterCard. Next chart. What a surprise that the earnings per share is leading the price higher. And I also own one that's been challenged. That's Schwab, which has been acting better lately. We know the story there. They call it cash shorting, but we know what that means. But I want to run through a few charts. John, throw them on. Goldman Sachs. Josh, you mentioned this. Not bearish. If the IPO window,
I think this will go to 500.
is going to open. This thing is rocking and rolling. It's an all-time high for Goldman Sachs. All right, next chart. Bank of America, 52-week high. Keep it rolling. What's next? Citigroup. Who owns Citigroup? I don't know. 52-week high. One more.
Yeah.
Wells Fargo, looking pretty good. All right, now where are we going next? Interactive Brokers, healthy looking chart. Keep it rolling. Ally, and this is direct exposure, not just to the consumer, but to the auto market, which I'm told is falling apart. And delinquencies are piling up. Well, stock looks pretty good. Next one, Prudential, life insurance company, or insurance company, I should say, A lot of insurance companies are looking good.
Look at these. If you didn't know they were financial, and I just put these charts in front
Say,
of you,
I'm buying them.
you're like a buyer.
All right. Anything else? Oh, and the last one, Josh, you spoke about NASDAQ.
I own this one. This one's going to take a little longer, but if there is a capital markets party in the second half of this year, this thing's going to go. This is NASDAQ, the company NASDAQ at 61. Those prior highs are not very far away. I think the stock is within 5% of its 52-week high. Relative strength has been a little bit weak recently, but the same reason Goldman looks like that. By the way, there were some charts. S&P Global, holy shit, this thing's like 470 right now, all-time record high, breaking a triple top. There are some charts in the investment banking stocks that looked really good. Ari did a whole thing on some of the capital market stocks. And the really easy way to find these companies is to look up the equal weight capital markets ETF.
What's the ticker?
So it's KCE. And you know who's in here? Evercore, FactSet, Moelis, Piper Sandler, a lot of the private equity stock. Anyone that has anything to do with capital markets. So Goldman's in this, but it's equal weighted. So it owns like 1.7% of every one of these stocks.
This ETF doesn't look that great. But either way.
You're not listening. I don't want to own the ETF.
Yeah,
I'm saying this is if you're interested in playing what I think is going to be a very active second half in capital markets, you don't want to own Wells Fargo. You want to find stocks that directly benefit immediately and are pure plays on IPOs, M&A, et cetera.
I'm looking at Jefferies. I mean, this looks like Eli Lilly. Like
it looks sick, right?
Anyway, JEF. Financials are 12.5% of the S&P 500. It's the second biggest sector. So in terms of like breath catching up and the baton being passed, like this could be the one, or not, but it can be.
In the chat, Moody's is another big name in that group.
Isn't that like a Buffett one?
I'm just some of the viewers. FICO, PJT Partners, SPGI. I mentioned that's S&P Global.
Yeah, these names are rocking and rolling.
These like all of these stocks look so good. And a lot of them. Here's what's interesting. These are other than Goldman. Like these are not mega cap stocks. These are $14 billion market cap, $6 billion, $25 billion. So there's a lot of opportunity in capital markets. If the stock market holds up, you're going to see underwriting come back. You're going to see M&A, all the things that these companies make money from, and they're going to roar. They're going to roar.
These names are kicking ass cheeks.
Somebody was saying JT Marlin. True. I have employee stock options in JT Marlin, so I'm all set. All right. I didn't do this on purpose, but here's a mystery chart for you. Hopefully you get it in 2 seconds. What do you think this is?
What do I think this is? JP Morgan?
No. We talked about it today.
All right. I mean, we talked about a lot of stocks. Can you give me anything else?
Well, we talked about it very recently.
Is it Moody's?
I don't know.
What is it? What is it?
All right. Give us the reveal. You just
NASDAQ?
You just made the case on this?
Goldman. Okay. Yeah, I mean, the stock looks...
That was your make the case stock, and I stumped you with it.
I didn't make the case of Goldman, just financials. Looks great.
It's the first chart you put up, but okay.
Looks great.
I have some more post-reveal. Can I show you some shit? This is a technical look at Goldman, relative strength at 70, very healthy, not crazy overbought. Here you see the 50-day and the 200-day parallel following the stock higher. And you see the stock just recently retested the prior highs from late 2021, bounced off of those numbers on low volume like they weren't even there. This is like, if you're in the market for a technical setup, you really can't do better. This is a textbook technical setup. Doesn't mean it's guaranteed to go up, but I'm saying like people that look for chart setups, if they came across this, they wouldn't care if it's Goldman Sachs or if it's AMC. They would be buying it. So
that's a buy, not investment.
It's a buy, and listen, trail it with the 50-day. The 50-day is 380. So it's a 20% stop. Like I know the stock is extended. So if you say to yourself, like I think I can make 50% in Goldman, but I'm willing to risk 15, 20%, trail it with the 50-day, and then every Friday.
My God, this is so bull toppy. If you think you can make 50% in Goldman, in 3 weeks or 4 weeks?
When Goldman consolidates for 3 years, normally the subsequent breakout is really big. Go back. Oh, here's my next chart. Can I show you this stuff? You see what I mean? This is since inception.
Sure.
So this is back to 1998 or 9 when they came public. No, but listen, can you listen for 1 second? Do you see it break that consolidation in 2005? The next thing you know, it's up 100%. Then it did it again in 2016. In 2020, it broke out again. Look what the stock did. Another 100%. So I don't think it's toppy to say this stock's been consolidating for 3 years, and now it's going. I don't even own this, by the way. I don't know. Is that so toppy?
No, looks good.
Looks good, right?
Looks great.
Keep in mind, the fundamentals are way better now than they were in 2021. In 2021, they were still feeding all these bullshit businesses, and the CEO was DJing in the Hamptons. That's not what's going on at Goldman right now. They cut all that stuff loose. They doubled down on the things that they're really good at, and they're earning a ton of money and buying back stock. It's a better business than the last time it was at this price.
Looks great.
All right. Hey, everybody. Did you know tomorrow is Wednesday, which means my favorite podcast, Animal Spirits, brand new episode on all podcast platforms. It'll be up here on YouTube later in the day. On Thursday, we have an all-new Ask the Compound with Duncan and Ben. Michael and I are back this Friday with a special guest. And Saturday, it's the one and only Jill on Money. Keep it locked on the Compound YouTube channel. And please make sure to visit our sponsor, ycharts.com/compound. Check that thing out. We used it a lot today. By now, you should know that is the best tool in the market. All right, we'll talk to you soon.